Hello and welcome to IVCA Conclave 2017. I have with me Mr. B. Prasanna from ICICI Bank Limited. Thank you for speaking to us, sir. What are your key takeaways from the IVCA Conclave as lead sponsor?
So at the outset, I think I should congratulate IVCA for a wonderfully programmed conference today. And I was also, like I mentioned in the panel, pleasantly surprised that this time around currency hedging also seemed to be one important area of concern for IVCA as such and the PE industry in general. So what we have seen in the past is that PEs typically don't do that much of currency hedging. So that's something that was a big takeaway for me. Other than that, the fact is that a lot of people discussed about the positivity in the Indian economy and the amount of capital that's being raised abroad, as well as what they are trying to raise within India. So those were very good takeaways. So broadly, it's been a very satisfying day.
Right. So you correctly said that there is a growing role of currency in private equity investment return space. What is your forward outlook for this?
When you look at the outlook for the private equity space, you need to first have an outlook on the economy, the interest rates, as well as the way the markets are going to move, and then we'll have to take a look at the PE space, because PE doesn't operate in vacuum, right? I mean, you need to look at that. So from that perspective, we are quite in a very, very healthy situation. I think the single biggest factor which contributes towards the healthy PE investment is the macroeconomic factors. Right. So typically, historically, it's always been that emerging market space are very volatile in terms of macroeconomic variables. You have the current account deficit, inflation, as well as the growth factors quite volatile when compared to, say, the developed markets, where there is a lot of stability in most of these factors, including interest rates, for example. So in the last 3-4 years, I think both from governmental steps as well as from whatever the Reserve Bank has done, I think India is definitely in a sweet spot. So we have the growth outlook still being quite positive. We have all the bad news behind us, and we have good things to look forward to. We have an inflation targeting central bank, which is very, very positive from an international investor perspective, because they know that now your investment in India is in positive, good hands, because inflation is bad for any investment, and if there is an inflation targeting country, it clearly means that the returns out of post-inflation real returns that you get out of the asset class will be a very positive return. So from all those perspectives, it's been a very positive time period for us to be in. Things are looking good. Of course, interest rates, by virtue of what's happening in the globe with the reflation trade going on globally, and the dollar strengthening, and even in the euro area, data coming positive, so on and so forth. You're looking at possibility of US dollar strength continuing, US rates going up, and hence the concomitant rise in rates in the rest of the globe. Yes. So that's something which anybody who operates in this market will have to take for a given, because it's a cycle at the end of the day.
So do you think interest rates will come down, not in the near future?
So that's an interesting thing, because post demonetization, I think the hope or feel was that interest rates will come down, RBI would cut rates and all that. But I think what's happened is that RBI is seeing through the data which has come out post demonetization as a very transient kind of data, which is possibly justified in the way the data came out very recently. The GDP data came out at 7% and the GVA came at 6.7, or rather GVA came at 6.7% and GDP at 6.7. So, so those things are quite positive. It has surprised the markets a little bit, but I think what's going to happen is that it's quite possible that because of the global upheaval in interest rates, we might not see RBI cutting rates. We might see RBI in a pause for a longish period of time, and depends upon how much US interest rates react. Does it go up substantially for Fed rate hikes, or does it kind of stabilizes between the 2.5 to 3% range, will kind of determine where Indian interest rates are. So when I say Indian interest rate, I'm broadly referring to the 10-year bond rates, for example. So to cut a long story short, while I believe RBI will be on a pause for a long period of time, maybe the next 9 months to 1 year, unless inflation comes so drastically lower on a sustainable basis that RBI wants to move and cut rates, I feel that rates are going to be stable, and the bond yields will possibly be reacting to the way US dollar will move, to the way the US 10-year rates were going to move.
Right. And you're happy with the GDP rates. You don't feel that there's anything to worry.
So like I said, I think November and December were possibly the worst months in terms of the anecdotal evidences that you are seeing from the ground, and we have already seen the data which has come out. It's a very good possibility that this data will be revised lower later on, because a lot of approximation happens in the advance estimates given out by the CSO at this point of time, but that's in the finer print and that's in the details. The data has not come out anywhere near the kind of expectations that some of the economists had. Like I said, there are a lot of details that still need to be answered and that needs to be reconciled. It's quite possible that the revision will come lower later on. But having said that, I think from an anecdotal perspective, like for example, two-wheeler sales and passenger vehicle sales was quite bad in the month of November and December, but has now recovered in the month of February substantially. So to some extent, we are, I think, the woes of the short-term woes of demonetization seems to be behind us.
All right. Thank you so much for giving us your time, sir.